Most people hear the word blockchain and they immediately think of Bitcoin or volatile crypto markets. But in the world of enterprise banking, blockchain is something much more boring and much more powerful. It is the ultimate truth machine. Right now, banks spend billions of dollars and millions of hours every year just trying to agree with each other on who owns what. They call it reconciliation. It's a slow, manual, and expensive process that hasn't changed in 40 years. But blockchain changes the game by moving us from individual ledgers to a shared source of truth. Today, I am breaking down exactly how blockchain is being used to rebuild the foundations of global banking, why it's the secret weapon for modern fintech architects, and what the future of tokenized finance actually looks like. Let's dive in. I'm Gokul. I architect enterprise systems here in Riyadh. Today, we are stripping away the hype and looking at what, how, and the future of blockchain in the financial sector. Let's start by defining what this technology actually does for a bank. To understand blockchain in banking, you have to understand the reconciliation nightmare. Currently, every bank has its own private database. When Bank A sends money to Bank B, they both record the transaction in their own silos. At the end of the day, they have to compare their notes to make sure they match. If there is a typo or a glitch, it takes human days to fix it. A blockchain is simply a shared digital ledger that every authorized party can see, but no single party can change. It's built on three pillars: immutability, which means the data cannot be deleted; transparency, everyone sees the same version; and consensus, the network agrees on the truth before it's written. In traditional banking, trust is something you buy through expensive audits and middlemen. In blockchain, trust is mathematically baked into the architecture. Instead of Bank A and Bank B keeping two separate sets of books and arguing them over later, they share a single permissioned ledger. When a transaction happens, it's verified by the network and locked into a block forever. This is the end of reconciliation era. We are moving from trusting the institution to trusting the protocol. For a fintech architect, this means you can build systems where settlement happens the same exact second the trade is made. We call this T0 settlement, and it is the core of financial efficiency. The technology isn't just about moving coins, it's about moving the truth instantly. Banks aren't using the public blockchains like Bitcoin where anyone can join. They use permissioned blockchains or enterprise DLT. In our world, the two biggest names you need to know are Hyperledger Fabric and R3 Corda. These systems are designed for privacy. When the ledger is shared, it's also partitioned. This means Bank A can see its transactions with Bank B, but Bank C, who is a competitor, cannot see a single byte of that data. If you want to architect for a bank, you have to master the identity layer of the blockchain. Banks cannot use anonymous networks. They need permission DLT like R3 Corda or Hyperledger. These frameworks allow us to build private channels where only the parties involved in the trade can see the details. We use PKI, Public Key Infrastructure, to ensure every participant is verified and regulated. As an architect, your job is to manage the consensus mechanism. You aren't just writing code, you are designing the rules for how a group of competing banks agrees on a single transaction without needing a central authority. It's a massive shift in governance design. When you move the identity layer to a blockchain, you create a system that is both compliant with regulators and invisible to the prying eyes. The real magic happens when we add logic to the ledger. We call these smart contracts. In a traditional bank, a contract is a PDF that lawyers have to read. In a blockchain bank, a contract is a code that executes itself. The true power of blockchain in fintech is smart contracts. Imagine a letter of credit or a trade finance deal where the payment is automatically released the exact millisecond a IoT sensor on a shipping container pings the blockchain that the goods have arrived. No paperwork, no manual escrow, and no 30-day waiting period. This is called programmable trust. As an architect, you are building systems that self-enforce. By embedding the business logic directly onto the ledger, you eliminate the risk of human error or fraud. We are moving from post-trade reconciliation to pre-trade validation. The code becomes the law and the ledger becomes the judge. If you can bridge the gap between legal contracts and executable smart contracts, you are the most valuable person in the entire fintech room. So, where is this all going towards? By 2028, we will be moving beyond just moving cash on a blockchain because we are entering the era of RWA, real world asset tokenization. We are going to take real things like a skyscraper in UAE, a barrel of oil, or a corporate bond and turn them into digital tokens on a blockchain. The next $10 trillion market in fintech is asset tokenization. We are moving away from physical ownership to fractional digital ownership. By turning a real world asset like a piece of real estate or a private equity fund into a blockchain token, we create instant liquidity. You can trade 1% of a building as easily as you trade a stock. For an architect, the challenge here is the design. How do you securely link a physical event in the real world to a digital token on the ledger? This requires building high security bridges between IoT, legal registries, and the blockchain. We are building the stock exchange of everything. By 2030, your investment portfolio won't be a list of bank statement. It will be a wallet of secure verified tokens representing real world value. But here is the day 2 reality. We don't have just one blockchain. We have dozens. JP Morgan has one, Goldman Sachs has another, and the central banks have theirs. The biggest challenge for the next generation of architects is interoperability. How do you get these islands of value to talk to each other? A blockchain is only as valuable as the network it can connect to. Right now, the industry is racing to build cross-chain bridges, the highways that allow a token to move from a private bank ledger to a public settlement network without losing its security or proof of reserve. We are using protocols like CCIP and atomic swaps to ensure that value can flow across the entire global economy without any friction. If you can architect a secure bridge that prevents double spending across 2 different blockchains, you have solved the biggest problem in the modern finance. The future isn't just one giant blockchain. It's an internet of value where every ledger is connected. Mastering the bridge is mastering the future of money. So let's recap now. Blockchain in banking isn't just about crypto. It's about efficiency and trust. It's a shared ledger that kills reconciliation, and it's permission networks like Hyperledger that protect the privacy. It's smart contracts that automate business logic, and it's the future of tokenization where everything of value moves as a digital asset. The books of the global economy are being rewritten in code. If you have any questions about Hyperledger, smart contracts, or how to start even building your first DLT bridge, drop them in the comments below. I'm Gokul and let's keep building.